Hi, welcome back to this, my fifth data update for 2022, where I look back at 2021 and try to make sense of the numbers. In this session, I'd like to focus on profitability. It's a proverbial bottom line. I know we live in an age where growth is glorified and scaling up is put first, but ultimately, profits do matter. And it looks like questions about money making and profitability have risen to the surface for a couple of reasons. One is there's been a little bit of a market pullback since the start of this year, and whenever markets pull back, it's almost a reminder to investors that making money matters. The second is COVID, we know, had an impact on earnings. The question of how much damage did in 2020 and how much of a recovery we got in 2021 is not just an abstract question. It lies at the heart of what we think about markets and whether they're under or overvalued. So in this session, let's talk about how much money companies made in 2021 and scale down how those numbers compared across companies. Now you'd think that we'd have some consensus on measuring how much money companies make. That if I asked you how much did your company make last year, that you'd have a simple answer. Especially since we're surrounded by accounting rules, IFRS and GAAP, and accountants who carry those rules through into financial statements. But measuring earnings is anything but straightforward, as accountants have multiple measures of earnings and within each measure, discretion on how to measure the profitability of a company. And also they have different ways of scaling those profits. So what I'd like to look at is the different ways in which you can measure profits and scaling them, and then talk about when you might use one measure over the other. So let's start with the different measures of accounting earnings using an income statement. Now, I'll make a confession. I'm not an accountant, so you might find that I'm cutting corners to do this. But here's what I see when I look at the income statement for a typical non-financial service company. Banks and insurance companies are very different creatures. So let's keep them out of the discussion. For a typical non-financial service company, you obviously start with revenues. It's what you generate when you sell your goods and services. From that, you subtract out the direct cost of producing those goods and services. So if you're an automaker, what does it cost you to make a car? If you're a software maker, what did it cost you to produce that extra unit of software? That goes into cost of goods sold. You subtract the cost of goods sold from revenues, you've got the gross profit of the company. It's the broadest measure of profitability. Now, of course, you have other operating expenses that, while they're clearly necessary for the company to exist, are not directly related to the production of goods and services. I'm talking about selling expenses, general and G&A expenses. You subtract those operating expenses from the gross profit, you got operating profit. From operating profit, of course, you first subtract out financial expenses, interest expenses being the most common one. And if you have financial assets, cash and marketable securities, holdings in other securities or in other companies, you add the financial income to get to pre-tax profit. You pay taxes, you get to net profit. Now, when you see earnings per share and net income often bandied about in public, it's usually net profit that people are talking about. But there's gross profit, operating profit, taxable income, and net profit. Now, what do those numbers look like in 2021? Well, in this table, I looked at the dollar values of gross profits, operating profits, taxable profits, and net profits, those items you saw on the previous page, across the world for companies broken down by sector. So let's pick a sector. If you take the energy sector, in 2021, revenues were $5.19 trillion. Gross profits were $1.58 trillion. Pre-tax operating profits were $532 trillion. Taxable income was $594 trillion. You're saying, how can it be higher than pre-tax operating profits? Clearly, there is other financial income that's supplementing pre-tax operating profits. And then you have net profits of $318 billion. So for every business, you see my breakdown of gross profits, operating profits, taxable profits, and net profit. The one note of caution for financials, just focus on the net profit. As I said, for financials, measuring things like gross profits and operating profits is kind of messy. So let's go with net profits. Across all firms, 2021 was not a bad year. Collectively, companies at about 64 trillion in revenues, about 21 trillion in gross profits, about 6.5 trillion in operating profits, and about 5.6 trillion in net profits. Now, of course, the question is, that was 2021, but 2021 was not even quite a complete year, because at the start of 2022, the numbers I had for 2021 were the first 9 months of 2021 and the last quarter of 2020. It's a trailing 12-month number. Now, of course, during 2020, we had COVID. So one thing that is interesting to look at is time trends in income, looking at the effect of COVID. So let's again pick a sector. If you look at energy, it started in 2017 with 272 billion in net income, climbed to 395 billion, dropped to 275 billion again in 2019, became 191 billion, minus 191 billion in 2020, before bouncing back in 2021 to 318 billion. Now, of course, the reason for those gyrations for energy are simple. It's the oil price. In 2020, with COVID kicking in, oil prices dropped to historic lows. They were down to almost $30 a barrel. They've since bounced back. But if you look at sector after sector, you can see that there's been a recovery in 2021. And collectively, the net income reported by all companies globally is about 5.6 trillion in 2021. And that was about 3% higher than the 2019 number. So in effect, we've come back from 2020 to where we were in 2019. And that's good news from the perspective of valuing companies. But you can see the recovery play out. That said, though, the range of the recovery varies across sectors. There are some sectors which are still underwater relative to 2019. If you look at real estate and utilities, the 2021 income is still lower than it was in 2019. So not all sectors have come back equally, and some have come back stronger than they were pre-crisis. Now, the problem with dollar profits is it's very difficult to compare them across companies, because larger companies obviously make bigger profits than smaller companies. So the question is, how do you scale them? Well, one obvious way to scale them so you can compare them across companies is to look at profits as a percentage of revenues. It's, of course, the classic definition of a profit margin. But that's pretty much where the consensus ends, because you have multiple ways in which profit margins can be measured. Of course, if you take the different income measures we have, gross income, operating income, net income, you can have a gross margin, where I take the gross income and divide by sales, operating margin, where you take operating income and divide by sales, and net margin. Of course, gross margin is generally going to be higher than operating margin, which is generally going to be higher than net margin. How much the difference is going to be, we're going to see in a minute. Of course, there are other variations on margins you might see as well. You could take the after-tax operating income. Well, what you do is you take the operating income, act like you pay taxes on that operating income. It's almost a hypothetical tax, and look at your after-tax operating margin. There are some people who take operating profit, add back depreciation to come up with a different form of margin, EBITDA margins. Again, the key here is analysts often use them to compare across companies. It's not that one margin is better than the other. It's that you have to be consistent when you compare across companies. So what do these margins look like globally? In 2021, this is a distribution of gross margin, operating margin, and net margin. First, notice that gross margin is definitely much higher than the other two. If you look at the median gross margin for a company globally, it was about 30%. That's pretty impressive, you say. Well, look at how much gets eaten away before you get to the operating margin. The operating margin for a typical company globally is about 5.7%. Net margin is 4%. So when companies boast about their gross margins being 30, 40, or 50%, you've got to be cautious. Those gross margins can translate to much lower operating margins or even negative margins. Now, if you look at the differences across sectors, as I've done in this case, you can see that gross margins vary widely across sectors. In communication service, for instance, gross margin is 49%. But look at industrials, it's down to 22%. Now, before you view this as a sign that industrials are badly managed, remember, this is a function of how much it costs you to make the products or services you produce. So not surprisingly, any business where the marginal product costs them very little to make, a software company, for instance, doesn't have to go out and make physical software. The additional piece of software costs them close to nothing to make, will have much higher gross margins than a manufacturing company. Now again, you can see the drop-off from gross to operating margin, and the degree of the drop-off varies across sectors depending on the other operating expenses you have. And finally, we look at the difference between operating and the net margin. The key driver is how much debt you take on. If you take a sector like utilities, there's a big drop-off between operating and net margin because utilities tend to borrow a great deal. But in contrast, if you look at tech, the drop-off is smaller, from 13.46 to 10.69%. Now, it looks like I'm spraying numbers at you, but basically I'm laying the foundations for thinking about the difference between gross margins, operating margins, and net margins, and why they can vary across sectors. I was also interested in differences across geographies. Are some parts of the world more profitable than others? Well, it does look like that, right? In fact, if you're looking at the most profitable parts of the world, you're going to be surprised. It's Eastern Europe and Russia, and Africa and Middle East. Now, you don't normally think of those as areas businesses make a lot of money, but there's a reason why margins are so high. Notice that when you look at US or European companies and they want to grow, they're not looking at Eastern Europe and Russia usually to grow, they're looking at Asia. Eastern Europe and Russia tend to be pretty close markets for lots of different reasons, and companies in those markets tend to therefore have less competition than companies elsewhere. So Eastern Europe and Africa and Middle East have the highest margins. The lowest margins in the world seem to be in Asia. You look at China, you look at Japan, you look at small Asia, which to me is all of Asia other than China, India, and Japan. The gross margins are down below 30%. In fact, the exception in Asia is India, whose margins are much healthier. But again, differences geographically don't necessarily mean that one part of the world is run more efficiently than the other. It reflects differences in the types of businesses you find in different parts of the world. So that's margins. Margins look at profits relative to revenues. But there's another way in which you can scale profits, where you can take the profits you make and measure it relative to what you invested to get those profits. It's called return on investment. It's a generic term, but there are two broad ways in which you can measure return on investment. And to see what those two ways are, let's look at an accounting balance sheet, reframed slightly differently. So you've got the liabilities, you've got debt and equity. And on the asset side, you've got operating assets, capital invested in operations, tangible or intangible, and capital held as cash. Here's the first way you can measure return on investment. You can look at everything through the eyes of the equity investors. What does that mean? You look at what capital equity investors have put into the firm. You let accountants measure it. It's captured with shareholders' equity or book equity. What goes in there? Everything that's happened to the firm. It's paid in capital, it's retained earnings over time. That's book value of equity. If you ask an accountant, what earnings would you attribute to equity investors? They're going to come up with net income. Return on equity is net income divided by book value of equity. To the degree that you trust accountants, and I've got to emphasize that, return on equity measures what equity investors get on their investment in the company. Now, there's another way you can frame profitability, and that is from the perspective of not just the equity investors, but all capital providers. Remember, you got capital from both debt and equity. Now, of course, some of that capital is being held as cash. Since it can't be invested in operations, it can't make an operating profit, so we net that cash out. What you get then, book value of equity plus book value of debt minus cash, is called invested capital. Now, if it's invested capital that you're looking at, the earnings you're going to look at is earnings to both debt and equity investors, which is operating income. And you multiply that by 1 minus the tax rate. Why? Because you'd have to pay taxes on that operating income. And that after-tax operating income divided by invested capital is return on invested capital. Now, I know people glorify these measures, but remember, they're accounting numbers. What does that mean? Every action that accountants take, good or bad, sensible or not so sensible, will affect your return equity invested capital. So I do measure the return equity invested capital for companies, but I take it with a grain of salt because I understand all the different ways it can throw you off. Now, what do those numbers look like across companies in January 2022? To compute these returns, let me emphasize how I did it. I looked at the earnings in 2021, the trailing 12 months. And I divided by the invested capital at the start of those 12 months. So basically, it's return on the starting book equity. Return equity would be net income in trailing 12-month 2021 divided by book equity at the start of that period, and return invested capital over that same period. Now, if you look at the distribution, the median return on capital for a global company in 2021 is about 6.91%. That's not terribly high. The return equity was even lower, about 4.5%. It's worth emphasizing, and I should have emphasized this when I talked about margins as well, a lot of companies have negative returns on equity or capital. So it's I'm going to put them as, they're really negative, not missing. The context of margins, same thing applies. There are companies with negative margins, and a third of companies have negative returns on invested capital or returns on equity. Now you might wonder, what now? I think having decent measures of profitability, whether it's margins or accounting returns, is good. It's good to have because it gives you ammunition on at least 3 different issues you will face in business. The first is when you run into a buzzword. Now, what are buzzwords? These are buzzwords. Buzzwords are words that consultants and experts come up with and say, this is the magic bullet. I think sometimes asking key questions about how will that play out in profitability is a good way to see if there's something behind a buzzword. Second, now I'm a great believer in corporate life cycles, as you know. Companies are born, they mature, they die. Looking at margins across the life cycle will give you a sense both of identifying where a company is in the life cycle and figuring out whether change is coming down the pike if a company is shifting from one stage to another. Third, I started this session by talking about how growth is glorified. More growth is better than less growth. And from a value perspective, that's never made sense. Growth can add value, it can destroy value, it can do nothing for value. And looking at growth through the lens of profitability can allow you to differentiate good growth from bad growth. So let's start with buzzwords. This is not a full list, but when I hear a buzzword, and some of these buzzwords have resonance because they have basis in business, often the question I ask is, where does it show up in my valuation? Remember, there are 3 places it can show up. It can show up in your growth, it can show up in your profitability, it can show up in your risk. In this table, I'm going to focus on the profitability effect. So let's say you have a company that claims to have a powerful brand name. What does a brand name allow you to do? Charge a higher price for exactly the same product. You know where it should show up? In your profit margins. So if you claim to have a strong brand name, I'd expect your operating margins to be much higher than the operating margins of your peer group. You'll hear young companies, especially they're growing, talk about economies of scale. Again, a completely sensible economic measure. It says that as you grow, your costs will grow at a slower rate than revenues. What does that mean for margins? When you're looking at these young companies, as they grow, their margins should improve over time. You'll hear companies talk about superior unit economics. You say, what are you talking about? Basically, it means that on the extra unit you sell, you don't have very much in costs. You have high gross margins because much of what you get on that extra unit is pure gravy. You'll hear companies talk about strong competitive advantages. That is better framed in terms of return on capital, that you have a high return on capital relative to your peer group because competitors can't come in and eat away at it. You'll hear some companies talk about how canny they are as borrowers. What does that mean? Your company might earn only an average return on capital, but it has a pretty high return on equity because you're using leverage to full benefit. Effectively, what you're doing is you're borrowing money at 4% and taking projects that make 8, 9, 10%. It's been the history of success in some sectors like real estate. And finally, some companies, fewer of them, boast about this nowadays, but if you claim to be good tax players, that they can play the tax game. Where does that show up? It shows up as a low tax rate when you compute the after-tax operating income. As I said, this is not a full list, but what I'm arguing for is when somebody throws a buzzword at you, it's often your job to ask where will it show up in the numbers, and one of the places it might show up is in the profitability number. And thinking about it will make you better at assessing the effect of that buzzword on value. Let's talk about corporate life cycles and how profits change over the life cycle. So you've seen this graph before of life cycle: startup, young growth, high growth, mature, stable, and then decline. When you look at profit margins, not surprisingly for startups and young growth, your profit margins are often negative or tiny. As you get into high growth, they turn positive. They continue to grow in mature growth. They stabilize during stable growth, and then they go into decline when you're a declining firm. You look at accounting returns, same kind of pattern, very negative early on. Now negative as your young growth company. They turn positive when you become a high growth company. They improve with economies of scale. They're pretty much at their peak during mature stable, and then they're going to decline again. Put simply, you should expect the scale profit numbers for a company to change as they grow. You're saying this is a theory, does it hold up? I don't want you to think that this is conclusive proof of what I just presented. But here's what I did. I took all companies listed globally. I broke them down by age from youngest, the bottom decile, to oldest. And I computed the gross margin, the operating margin, the net margin, as well as the accounting returns for these companies. Now you can make your own judgment, but you can see that as companies go from youngest, the bottom decile, to fifth, sixth, seventh decile, both margins and accounting returns tend to climb. And then as they get to age, the numbers start to decline again. So at least that's kind of, that at least weak evidence that there is a life cycle effect out there. Now, of course, when you think about age and you think about corporate age, you look at the time it was founded to right now. But one of the arguments I've made about tech companies in the US in particular is they age in dog years. What I mean by that is tech companies scale up really fast. They go from nothing to 100 billion in 7, 8, 9, 10 years. They don't last at the top very long before they go into decline. Yahoo, classic example, 25 years from start to finish. You're saying, so what? So I've argued that when people talk about this tech sector in the US, that talking about the tech sector as if it's a monolith is dangerous, because the tech sector right now is composed of some older tech companies like Microsoft and Apple, and very young tech companies. They're very different in how they behave and how profitable they are. So what I did was I took just US tech companies and broke them down by age from youngest to oldest again. And here again, in much stronger form than you saw with global companies broken down by age, you can see the age effect. The very youngest tech companies, you're right, are big money losers, huge negative margins and negative returns on capital. But the oldest tech companies are among the most profitable companies in the market out there. So when we talk about tech, we've got to be very clear about, are we talking about young tech or old tech? Because we're talking about two very different groups of companies. Just as a side note, I've been pretty harsh on value investors. And one of the reasons I've been harsh is they have these rules that cut out entire chunks of the market. For instance, for the longest time, there were some value investors, I'm not trying to paint everybody with this broad brush, who refused to buy tech companies. Why? Because they said tech companies are not that profitable and they're very risky, which might have been true in the 1980s and 90s for most tech companies, but it's definitely not true today. By eliminating tech from their choices, they remove some of the most profitable, valuable companies in the market. In fact, you could argue that many of the older tech companies fit better into good value investments than buying Kraft Heinz or Coca-Cola. Now let's talk about the value of growth. Well, growth is good, right? It pushes up your revenues and earnings, but growth also requires reinvestment. So there's a negative effect and a positive effect. One of the shorthands you can use to judge whether growth will create or destroy value for you is look at the difference you make between as a return, the return on equity and return on capital, and what you should have earned, which for equity investors is the cost of equity, and for capital is the cost of capital. Return invested capital minus cost of capital you can think of as an excess return, what you make over and above the cost of capital. Return on equity and cost of equity is an excess return on equity. Here's the rule. If you're a business that consistently earns your cost of capital, growth will do nothing for you. You will just run in place, because whatever you gain with growth, you will give away in reinvestment. If you're a company that earns more than your cost of capital, it's true, growth is good for you, because when you grow, you're taking projects that make more than the cost of capital. But if you're a company that earns a return on capital less than your cost of capital and you grow, you will destroy value as you grow. Now you're saying, well, how many companies would take investments that earn less than the cost of capital? Well, quite a few. Here's the distribution of excess returns in 2021. So what I've done is taken the difference between return on capital and cost of capital across the world, broken them down by region. Let's look at the global distribution. It's pretty horrific if you ask me. about 57% of companies globally. There are almost 39,000 companies. I'm looking at non-financial service companies because, again, with financial service companies, you focus on return equity. And they tell pretty much the same story, but here it's non-financial service companies. Almost 40,000 companies. 57% of these companies earn less than the cost of capital. 43% earn more. It's a very bimodal distribution, right? There are companies that earn more, have excess returns that exceed 5%, and the other extreme, you have companies that have excess returns which are worse than minus 5%, and not very much in the middle. If you look across regions of the world, well, there isn't any region where you make substantially more than your cost of capital, but some regions do better than others. For instance, if you look at Japan, it is one of the two regions, China is the other, that where more than 50% of companies at least beat their cost of capital. Maybe not by much, maybe collectively you still have this problem. But if there are differences across, it's mostly because of differences in sectors that you see in different parts of the world. But the bottom line is a lot of companies earn below their cost of capital. There are three implications I want to draw your attention to as a consequence. The first is, if you remember in my last data update, I pointed to the fact that costs of capital were at historic lows. They're down to about 6.3% globally, 5.8% for US companies. And if I just put that out there, many of you are going to say this should be the golden age for companies, right? The cost of capital is about 2 to 3% lower than it was 20, 30 years ago. This must be great for companies. And they must be earning well above the cost of capital, as you saw in the previous table. That's not true. The same forces that are driving interest rates low are also changing the macroeconomic environment in such a way that companies are having a harder time earning returns that exceed the cost of capital now than they used to. So in a strange way, when costs of capital were 8, 9, or 10% 20 years ago, companies had an easier time earning more than their cost of capital than they do now, when cost of capital is 6%. Second, when you think about return capital and cost of capital at an individual company level, that tells you whether a company makes more than its cost of capital. But since I also aggregate by industry, I can look at what industries have most of their companies earning more than the cost of capital, and what industries is the exact opposite. In other words, I want to get a sense of what businesses, if I want to enter a business, are good businesses where most of the companies earn more than the cost of capital, and what businesses are bad businesses. Again, caveat, this is based on 2021 numbers, so some of these companies might have a good excuse for 2021, but at least based on returns on capital and cost of capital in 2021, I've listed the 10 worst businesses and the 10 best. Let's start with the 10 worst. It's biotech companies. You're saying, why are they there? Well, they have a good excuse, right? Many of them are young, they're in production, they have R&D expenses, they're losing money, but if the drug makes it, they're going to be blockbuster companies. So maybe there what I'm capturing is the fact that they're young companies early in the life cycle. If you're an ESG person, you're going to point to the fossil fuel companies. Say, there, we did it. But before you start celebrating too much, 2 points as pushback. First is, well, if oil prices go to $100 a barrel, those companies are going to go from bad to good businesses overnight. The other is, if you look at the very best of the good businesses, it's tobacco. Not exactly a stalwart of the ESG movement, right? Not a company you'd view as a good company. Now, one final sector that I want to focus on is, of course, air transport and hotels and gaming show up year after year after year. So some of these businesses have been bad business for quite a while. And notice that they still continue, not just to exist, but companies keep entering these businesses. Entertainment is a newcomer to this list. It's not been a bad business until very recently. And you say, what changed? Well, Netflix changed the business. It came in through money ad content, changed the business. And I think there's a lesson here, which is, when you have disruptors come in, it can ruin a good business. But don't be quick to jump to the conclusion that the disruptors must now be making money, because disruption is easy, but making money on disruption is difficult. And as an example, Uber and Lyft and Didi and Ola destroyed the cab service business and the old car service business. It's devastated them. But you know what? None of the ride-sharing companies have figured out how to make money. So the disruption has happened, but the disruptors are still struggling with the business model. Now, if you look at the good businesses, you do notice, some of the tech business, information services, computer services. But notice there are quite a few old tech, old economy businesses, chemicals, specialty and diversified, and building materials, retail, and furnishing seem to have stuck in there. In fact, of all the brick and mortar retail businesses, it looks like building supply retail has held up the best, partly because you might not want to order your plywood from Amazon, and Amazon doesn't want to deliver it. Home Depot is a much better shot of fighting off disruption than Bed Bath & Beyond. Again, this is, I look at these good and bad companies and businesses every year not because I'm trying to point a finger at these businesses, but I think it's good to think about why do businesses turn bad, and what do you do if you're a company in a business that's turned bad. One final point, and this is the point that I've been making, which is disruption has changed some of these businesses, made them go from good to bad businesses. But disruption is easy. Making money on disruption is difficult. And I think you see this play out in business after business that's been disrupted. So I hope this session has been useful and it's given you a new perspective on profitability.